Hey, everybody. It is a sunny Friday. It is episode number 107. And you know what that means? That is right. It is a real deal pod with Allister and Geoff. As always, it is I, Allister Carrington, your trusted realtor, alongside our trusted mortgage broker, our mortgage guru, Geoff Lee. Geoff, buddy, how are you doing on this sunny Friday?
Yeah, sunny today, but apparently raining for the weekend. So
yeah, yes. Ugh.
Well, we need the rain to water the grass.
No, it's true, man. Actually, I was saying that to Michelle. I was like, I'm not happy that the rain is coming, but I'm happy that the rain is coming because you can legitimately feel the earth begging to be cooled off, and it was hot yesterday. It's supposed to be super hot again today, so it's just begging to be cooled down right now, man.
Yeah, I have a big biking ride to do tomorrow, so we're going to from what I understand, I don't know, I'm kind of just a ride along, but I think we're going to be starting in Burnaby, going up to Seymour, which won't be fun in the rain, but
Wow.
But there we go. It's going to
There
be a big
you go.
climb.
You guys are such troopers. Like going in when it's going to be pouring rain and like very, very little relief of it in sight. And you're still out there on the bike going, I'm a wimp. My black butt is staying inside, man. For real. I'm like, nope, I'll melt. It's raining out there.
It's called midlife crisis, Allister. You're just not there yet.
Jeez, man. Well, good on you, buddy. Good on you. I myself am going to take the weekend to actually relax and enjoy. Finally got my client's condo sold up and passed on the keys to the new owners yesterday. So they were so cute, though. I got to say, they were so happy to get the keys. And I was with the buyer's agent. Normally, they're the ones that give the keys, right? But they just happened to show up at the same time I was giving the realtor the keys, and they were so cute because they were around me and thanking me and all that sort of stuff. And I'm like, well, thank your guy. He did a great job in this too. But it's really nice to see when people are happy getting their home and all that sort of stuff. Yeah. So it was really nice. So I'm going to take
it's a stressful experience for a lot of people if they're not working with the right people, right? So
well, no, and I will say that that's actually one of the biggest things. I know we talk about that so much, having the right people working for you, but it is equally important to have two realtors that work together, right? And that don't try to make it an adversarial relationship or anything like that, or try to have egos get in the way or anything like that. Because shout out to Roy Zhu. He was amazing to work with. So just that made it so easy, and that's what made the experience for his clients so happy too. Is that you had two realtors that any information, anything that needed to be done, got done timely, and it just made the transaction seamless. So shout out to the other side as well. Yeah. So
absolutely.
Yeah, man. Well, let's get into it. Let's get kicking and start it with the hottest segment in podcast, and that is...
Did you know?
That's right, baby. Did you know? So, Geoff, did you know that two of Canada's biggest housing markets, right here in BC and over in Ontario, are headed in completely opposite directions over the next few years, according to CMHC?
Do tell.
All right. Well, same country, same interest rates, same economy, and totally different forecast. So here's the setup. Every year, CMHC, so as we know, that's Canada's National Housing Agency, puts out a forecast, right? Every year they put out the forecast, then checks it back mid-year to see how reality is tracking. And as we know, this summer check-in just landed, and the headline is blunt. Even the weak market that they predicted for this year turned out to be weaker still, especially sales and prices. prices are sliding, and even with homes getting more affordable, like we keep continuing to say, buyers again simply aren't coming back in any real numbers, and they're still being cautious. And that's the mood everywhere. But here's where it gets interesting, because CMHC's forecast for what comes next splits sharply by region. So starting with home building, in Metro Vancouver, roughly 27,000 homes broke ground last year. This year, we're expected to land a bit lower at around 26,000. And it doesn't stop there. CMHC expects that number to keep sliding down to somewhere between 20,500 and 22,000 new homes by 2028. So I just want to pause on that quickly, because we started out this year with all this gusto on how we were going to be bringing new built properties to market, right? Isn't that what we started talking about, Geoff? Beginning of the year? And we're already now slated to finish less housing than we created last year. And by 2028, we're supposed to be down another 5,000, 6,000 homes to that.
Here in BC.
Here in BC. That to me struck wildly, because again, we're talking about affordability too. The reason why we're creating all of these homes was to bring affordability back, bring the cost of housing back down, and all of that sort of good stuff. And now we're building less homes. Right?
Well, are we building less homes in BC because it's just the development side of things is they put a pause on it because of the market, because of the existing quantity of homes, which we've talked about before, that are vacant. I would assume that they go hand in hand.
Yeah, well, that you would think so. And this is the part where it gets interesting with Ontario. So Toronto starts in almost the same place this year. We've talked about how we mirrored them, and they've mirrored us throughout this year, right? But instead of continuing to fall, Toronto's expected to turn around and start climbing again in the years after. So we're expected to fall going through to 2028, but Toronto is expected to see an increase. Right? Now, the part that really drives it home, the resale side tells the exact same story. Vancouver sold about 30,800 homes last year, right? This year is expected to land lower, somewhere around 28,000 to 28,800. From there, CMHC does expect some improvement, but it's modest, climbing back up to maybe about 29,000 to 33,000 sales by 2028. Toronto, on the other hand, is expected to jump from around 63,000 this year to as many as about 77,000 by 2028, which is a genuinely big gap, right? So why the split? There's a few things that are stacking together. Population growth has slowed everywhere, which is hitting BC and Ontario's condo markets the hardest, as we've spoken about. Builders are responding to unsold inventory and high construction costs by simply building less. That's what we just spoke about. And CMHC says that the pullback will be most visible right here in BC's condo sector specifically. Adding in high borrowing costs and slow income growth, and you've got a market that's adjusting downward, but adjusting for longer in some places than we're seeing in others. There is one bright spot buried in all of this, though, and it's worth flagging. It's the renters. As developers keep shifting from building condos to building purpose-built rentals, CMHC expects that new rental supply to keep easing the rental market, pushing vacancy rates up and slowing rent growth, especially in the biggest cities like here in Vancouver and Toronto. So, Geoff, What do you think about all of that news that we were all told at the beginning of the year, and to now what we're seeing, basically, well, not midway through, but that's when they come out with the data, right? That's when they do the mid-year report. So how do you feel about that mid-year report, considering everything that we were told at the beginning of the year?
I question the comment on why say housing is stale right now with high borrowing costs. Though
Right.
that jumps on me a little bit because I believe, and we're going to talk a little bit about this today. I believe we don't have high borrowing costs. I we have some of the lowest rates that our country has seen prior to COVID. Um, we have a market that has corrected, which affects a lower down payment and an overall possibly a lower monthly borrowing cost than if you were to buy in a regular market. Yes, there is like slowness to the income, and maybe that hasn't grown as much. But I don't know. I would challenge that comment that I would read in that report of high borrowing costs as far as why people are not buying. Um,
So I want to tag on to that with you. So I hold your train of thought, because I agree with that completely. And we talked about it actually last week. I think I mentioned it on the pod. This is actually a reoccurring thing that I read during articles. They have now been putting in high borrowing costs. And that's why I reaffirmed with you last week. Like, aside from COVID, we are one of the lowest borrowing, right, rates that we've ever seen. And this is why I've said, isn't it this, we've got to start reframing the people's mind from stop thinking about a 2% rate or a sub 2% rate, because the rates that we're looking at right now are probably going to be the rates of the norm for quite some time. That
Yeah,
3%.
I think high borrowing costs were actually relevant when everybody was super comfortable about being in the market.
Yeah,
Those were high borrowing costs.
sure.
I believe in today's market, it's actually the opposite. I believe it's a low borrowing cost. So I would challenge that part of that study,
I
right?
agree. Yeah, I agree with
Uh, I in regards to BC housing, that doesn't surprise me based on the amount of vacancies we have, based on the lack, based on the I won't say overdevelopment, but the development that BC has completed or is in the stages of completion. Um, I'm curious about Ontario if that's not factoring in that huge buyout from the government,
No,
which
we
has
got the
yet to.
buyout. We got the buyout on the condos. So what? So what's going to drive? And so this is the one thing I wanted to be able to pull some numbers for. Maybe I'll get some numbers for next pod. But the biggest thing that's been driving Ontario, because Ontario's real estate has been moving over the past couple of months like crazy. And the reason is they had that HST relief for homeowners, and so they were so it was able to take their taxes down. Like, they were saving ungodly amounts of, I think it's about $150,000 on a home with the HST relief, right? And all and because we don't have harmonized sales tax, we can't do that, right? So that's why they were trying to figure out some little bit, like the $40,000 grant or whatever they're trying to give buyers here in BC to match what Ontario's done. Doesn't really match, because the numbers don't work. The numbers
Yeah,
don't work out because of because of the way the tax can be written off in Ontario versus you can't write off the tax like here in BC, because it's not harmonized.
yeah,
Yeah.
yeah,
It's
yeah. It's
wild.
interesting.
Yeah, it's interesting. It's gonna be really, so that's why when we talk about when the bottom's gonna come and all this sort of nonsense that's going on, and I'm waiting for the bottom and I'm trying to time the ball. There is no real way to know it right now. There's so many extenuating circumstances, and we just to keep it in the numbers for Canada. It, like, I didn't even get into the part where they were talking about the war, the Iran war right now. That's also factoring in to a lot of these to a lot of these numbers as well, right? So there's so many things going on outside of our borders that are factoring into this that we're not even speaking of.
Yeah, yeah.
Yeah, man. So that's the did you know, and now you do.
Thank you.
You're welcome.
I wanted to talk about mortgage rates.
Yeah.
I wanted to talk about, people's thought process as far as, should I wait for mortgage rates to drop before buying a home? And I also wanted to kind of, just go into a little bit of a rabbit trail as far as when people ask you, well, what is the best rate? Because again, we've talked about this countless times as far as the only questions, not the only, but most people's first question is, well, what is the rate?
Yeah.
We don't hear this as much as we've had in the past, but at one point we were hearing, I'm not going to be jumping into the market because I want rates to drop more than where they're at, and I'm going to wait for the next Bank of Canada meeting, right?
Yeah.
And I just think, it's really important for people to understand a couple things here. Is when you're going to anybody and asking them for what is the best rate, understand that when you ask that question, Allister, there's 20 rates, 20 plus rates that you may be qualified for, right? And we've talked about this in the past, but I wanted to bring it up again, is that, there's 20 plus rates that you can qualify for depending on what you're doing with the property that you're buying, or even depending on what you're doing with refinancing a property that you currently own, right? So in order for someone to answer that question, is really, what are you buying? What is the purchase price? How much are you putting down? What amortization are you choosing to use? Are you purchasing something that you're going to live in or something that you're going to rent? There's over 20 different rates if those questions are not being asked.
Yeah.
So again, as an education moment, I want our listeners to understand that when you ask that rate and there is no questions that are being asked, and somebody is just giving you a rate, you might basically be getting the wrong rate moving forward in a way that is going to basically kick you in the balls.
Yeah.
Well, let's not say that. Kick you in the face, when rubber hits the road, right?
Yeah.
So again, when you're asking, your lending partners, well, what is the rate? If they're not asking you, what are you buying? What is the purchase price? How much are you putting down? Right? What kind of amortization are you choosing to use? Are you going to be living in it, or is it going to be a rental? If they don't ask you those questions and determine which sandbox that you're falling into, again, the rate that they're giving you could be totally incorrect, because again, the rate range between how you answer those questions, Allister, as of today is anywhere from a 3.55 to a 4.75%.
Right.
So quite a spread.
Right.
Right?
Yeah.
So again, if the questions aren't being asked to determine which rate sandbox that you're falling into, the likelihood of the rate that you've been quoted is probably not going to be very strong. Especially, too, folks, is that if you're going on rate sites and just seeing what the rates are, they don't ask you these questions. They just basically give you the rate, assuming or marketing it as you're purchasing it with less than 20% down, you're buying it with a purchase price of less than $1.5 million. And basically what you're seeing is the insured rates. And again, it's like a fish hook when you're going fishing. It's just to hook you in, get the conversations going. A lot of times we've seen even pre-approval starting. They get the pre-approval letter. They're expecting the rate. They go out and start working with the realtors. They put an offer in, and all of a sudden, you're not putting down less than 20%. You're putting down 20% or more. Or that purchase price is higher than 1.5 million. Or you've chosen to do a 30-year amortization over a 25-year amortization, or maybe you're buying an investment property. Now, all of a sudden, that insured rate that you got off a rate site and did, and followed their pre-approval process, or their, now when rubber hits the road, those details are different. And now the rate that you've been pre-approved for is different. So again, I wanted to make it very clear. When you are asking for what the rate is, or if you're shopping for the rates online, understand that there are questions that need to be asked to determine which rate sandbox that you're in, because the range is anywhere, as of today, which is August 21st, 2026, can be anywhere from 3.55 to 4.75%, right? Maybe a little bit lower, maybe a little bit higher, but that is at a very high level as far as what the rate range could be if people aren't asking the right questions.
And just to tag onto that, as somebody that, again, gets asked that all the time when you have that first meeting, for all the realtors that are listening, that is why, again, it's so important to know the person that you're working with, the mortgage broker you're working with, and get that information, because I appreciate the relationship that I have with Geoff so much, because I get that rate range information, and then I'm able to faithfully sit in front of them, or stand in front of them and say to them, now, when it comes to what is the best rate for you, that is so far out of my wheelhouse, because there are 20 different rates that you might, or 20 different buckets that you might fall into with various amounts of rates. So that's why it's so important.
Not 20 bucket sales, or 4 buckets.
4 buckets, 20, yes.
20 plus rates. If you don't determine which bucket you're in.
Which you're in. And that's what I mean, is that's why it's so important for you to sit down. And I say, sit down with Geoff, for me to get you to sit down in front of Geoff, so we can see which one you exactly fall into, right? And that's what's so important from the realtor end, is that if you're not getting that same type of information from your broker, your team member that you work with, then again, it's you should probably look for somebody else.
Yeah, and again, I think it's important. Let's talk about what those buckets are, right? Yeah. Like, one of the buckets is if you're purchasing something less than $1.5 million and putting down less than 20%. That's called an insured bucket, right? Then there is an insurable bucket, which means you're purchasing something that's less than $1 million or less, and you're putting down 20% or more down. There's actually 8 different rates within that bucket, and that's called an insurable bucket, right? Then there's an uninsurable bucket, which means you're putting down 20% down regardless of the purchase price being $100,000 or $1.9 million.
Yep.
And you're putting down 20%, and that's called an uninsurable bucket if you're using a 30-year or a 25-year amortization, right? And then there's your investment bucket if you're purchasing something that is a purely rental property, right? So those are the 4 buckets. And within those 4 buckets, or surrounding those 4 buckets, depending on which one you're going to get determined to drop in, there's 20 plus rates if those questions aren't being answered, right? So again, to your point, Allister, is that, if you're asking your realtor what the rates are, probably not the best person to ask unless they're giving you the rate range.
Right.
And if you are working with a lending partner and they're not asking those questions, there's a high likelihood you might be getting quoted the wrong rate, right? Yeah. And for sure, when you're jumping on a rate site online, or even using ChatGPT, and you're not prompting them with exactly, the purchase price, with your down payment, with the amortization, is it going to be an investment property? Again, ChatGPT is great, but it's only great with what you feed it, right? Yeah. So again, unless online rate sites, unless they're asking you these questions, it's quite likely you're not getting quoted the correct rate. If you're using ChatGPT without prompting it correctly, it's quite likely you might be getting quoted the wrong rate in the wrong bucket, right? Yeah. So again, I wanted to kind of get a little bit deeper into this rate conversation, because again, I think this is a great pod, because a lot of our listeners, even with all the education we've given, their first question, and sometimes maybe their only question, is going to be, well, what is my rate?
100%. 100%. This is exactly why this is so important.
Right. And here's the other thing. People out there, if you are waiting for rates to drop, I'm going to tell you, and I don't have a crystal ball, but this is just my understanding and my predictions. You're going to wait a long time.
Yeah.
Right. Understand, folks, that again, Allister, we're in the second lowest rate environment that our country has seen since COVID.
Yeah.
Right.
Yeah.
And if people out there are expecting to see rates that are lower than 3%, you're going to be waiting a very long time. Right. I could be totally wrong, but again, I've been doing this a long time. I've seen a lot of things in my years, and I got 30 years of real estate investing in my blood. I got over 15 years of financing experience in my blood. I'm 56 years old, so I'm in my golden years. I've seen a lot.
Yeah.
And again, if we're waiting, or if you're waiting to see these rates drop to where they're at now, you're going to be waiting a very long time, right?
Yeah. Geoff, let's just quickly examine what it took to get rates to drop that low. It took a pandemic that nobody had seen since the Spanish flu, which was in the 1800s, to get the rates, to get for that perfect storm to be created, where the government was giving away free money and they had to spur on an economy and drop lending rates and all of that sort of stuff to create that type of rate environment. Yeah. What are the chances that we're going to see another epidemic the size of a Spanish flu or COVID, which happened 200 years later, right? Again, in the next, 5 to 10 years.
Yeah, based on history, another 200 years. But again,
that's what I say to people.
Don't know.
Waiting for rates to drop to back to down to 2% or whatever. I'm like, you know what it took, right? And again, we say I'm not a crystal ball. It's just I kind of look at history. That doesn't usually happen, right? So yeah, it's just I always I laugh at that waiting for the rates to drop part now, and I always use what you're saying, guys, we are in the second lowest lending rate that we've seen. You take out COVID, right, and look at the rates that we're seeing. We would be happy.
COVID, in a way, has been a gift a gift or a curse to the current market that we're in, right?
Sure.
It's a gift if you understand and you're comfortable where rates are and where the market is. It's a gift because it's a great opportunity for people to buy.
Yeah.
Right. It's a curse for people that are living in fear, and the fear of making a wrong decision, because they have the PTSD as far as what they're hearing in print and media, right? And again, that comment can go one of two ways as well. That comment, in hindsight being 2020, that comment can come back to being the smartest comment in the world in 3 to 5 years, or it could be Geoff, what were you smoking? Because things aren't getting any better. Yeah. And again, Allister, there's arguments for both sides. We are in an era where I can have this opinion, and I say this every time. Mm-hmm. I can have this opinion or this opinion. I'm going to find lots of people to agree with me or disagree with me, right? Yep. But at the end of the day, and I'm going to say this time and time again, if you are building your future, if your net worth is important to you, and again, we always reference CMHC study. And again, I'm just going to keep it really high level. People who own homes have a much higher net worth for people that don't own their homes.
By a minimum of 100 times.
If you take a look at people even in your own life as of today that are 50, 60, 70 years old, right? Ask them what their net worth is if they're a homeowner, to those same people, or to similar people that don't own a home. Mm-hmm. And again, folks, I'm a firm believer that your net worth, your quality of life as you get older is going to be determined by home ownership and what you purchased and what you've sold in your lifetime. The income that you earn gives you the opportunity to buy and sell. The income that you earn with the majority of Canadians is not going to determine your net worth, because most of us don't save a penny of what we make.
Yep.
Right? Your homes are your biggest piggy bank.
Yep.
So anybody that will say, well, I think it's better to rent than own, I would have a very strong, I would actually love to have a conversation with them on it.
Yeah.
Right? Because I don't think their wave of thinking is correct.
Yeah, I'd like to see the financial. I'd like them to see their just break down their financial math, because you can break down the financial math to make it work on your side. But like we were just saying, that's in a perfect world, right? And there's 90% of people that wouldn't follow that discipline in order to make that work. So I agree with you wholeheartedly. Your home is your biggest piggy bank. Period.
Yeah,
that's just plain and simple.
Yeah. And again, as we're on this, like rates this year in 2026, our overnight lending rate hasn't moved in 2026, right? Our next Bank of Canada meeting is September 2nd. For those who understand on what that overnight lending rate means and what the Bank of Canada's decision is based on, typically it's based on where Canada's inflation rate is, and that is an ingredient of a whole bunch of different things to determine what that outcome is. Right now, Canada's inflation rate, folks, is at 3.2%, right? The ideal market is between 1% and 3%, with the sweet spot being at about 2.3. So again, there are discussions that our overnight lending rate, which will affect variable rate mortgage holders or any kind of financing or loan that has a prime rate, there are discussions that overnight lending rate may be bumped up in order to control the inflation and get that 3.2% back between that 1% and 3%. Most people will agree that's not going to happen September 2nd and for the remainder of 2026. Some will argue that, hey, if this continues to be the way that it is, we're going to see some rate increases in 2027. But again, if you take a look at the history of even this pod, that conversation seems to change every 7 to 14 days, right? So again, if things were to move, also understand, guys, is that a quarter of a point, which is 0.25%, and typically that's where rates will kind of move, be it a fixed or a variable. Typically, they're not at one time increasing higher than a quarter of a point. Understand that if that is to happen, on every $100,000 that you own or that you owe is only about $14. So if you have a $600,000 mortgage, or you're going to apply for a $600,000 mortgage and you're fearful of the rates because it might increase, a quarter of a point on 600 grand is about $83, right? People think it's going to be hundreds to thousands of dollars.
Yeah. Yeah.
Right. And that's not to minimize what happened when our variable rate or our prime rate went up 8 times in 11 months. Right. That's not to minimize that.
Yeah.
But again, what I will tell you, that what Canada is really good at is learning from its mistakes, especially on the banking side. I don't see that happening again on the variable side. And again, if you go into a fixed term and you lock in for 5 years, it's going to be irrelevant for the next 5 years. Right. But where we are at with rates are basically, in my opinion, are going to float a little bit up. They're going to float a little bit down. But I think this is the new normal, which again is not a bad thing. We're in one of the lowest rate environments that the country's seen, right?
Yeah.
So with that, that's my discussion on rates. And again, like to get even a little bit deeper into the conversation. Well, I want to rent versus I want to buy. We work on files all the time. And I'll tell you right now, with today's pricing and with today's rates, it is quite often that we're seeing home ownership cheaper than renting. And that home ownership, again, if your net worth and your quality of life is important to you as you get into your golden years, and a lot of times when you're 20, 30s, even 40s, you're not really even thinking about the golden years. But I can tell you, take a look at statistics. When you're a homeowner throughout your lifetime, you are going to be you're going to be in a much better situation when you are retiring, due to buying and selling a home, right? So,
Yes. Yeah.
and
Amen.
that's where we're going to end it.
That's awesome. That's awesome. And to quickly just to tag on to that. I mean, I know we keep hearing, our pod hear it in the news that, the market is down, this, that, and the other. It's true, right? But also remember that there are still sales happening when it comes to the townhouse category and the single family category. The part that's really dragging down, right, sales is the condo market, because there's been so many things done to that market. So there still are sales, and there's still things happening in the market. And I want to bring that right back around to the first time buyers when we talk about these condos. The rates are in the lowest that we've seen in the longest amount of time, right? Condos are as affordable as they've ever been since 2017. To be able to get yourself and position yourself into the market so that you're increasing your net worth literally by 100 times, right? Because as we've said on the market, those who rent and have a job make 44,000. Those who own a condo and work are worth 440,000. That's 100 times difference, guys. So just please, I just want to let those numbers resonate as we sign off here on just, we are in a time of affordability, where, it's something that people have wished for. And so I think it's something that people should really get back into looking at. Anyhow, we hope that we've given you at least a couple of nuggets to take away this weekend. Have an amazing weekend. Stay dry. It's a rainy one. Stay dry, but enjoy it. We encourage you, and we tell you, we ask you to continue to love, like, share us, tell everybody you know about us. Woo! We'll see you back here next week for episode number 108. My man Geoff, have an amazing weekend. Have a good ride out there. In the meantime, most importantly, stay empowered, stay informed, and Geoff,
Stay tuned.
That's right, baby. Stay tuned. Peace out.